Ladies and gentlemen, good day and welcome to PNB Housing Finance Limited Q1 FY2025-26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika Gupta Padhi. Thank you, and over to you, Ms. Padhi.
Thank you, Renju. Good morning and welcome, everyone. We are here to discuss PNB Housing Finance Q1 FY26 results. You must have seen our business and financial numbers in the presentation and the trust release shared with the Indian Stock Exchanges yesterday evening, and it's also available on our website. With me, we have our management team led by Mr. Girish Kousgi, our Managing Director and CEO. We'll begin this call with the performance update by the management, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 45 of the investor presentation. With that, I will now hand over the call to Mr. Girish Kousgi. Over to you, sir.
Thank you, Padhi. Good morning, everyone. Thank you so much for taking a precious time out in the morning. I am pleased to present the Q1 FY26 performance. On the industry, this quarter, RBI announced another 50 basis repo cut to 5.5% with immediate effect, and reduction in cash reserve ratio of 100 basis, staggered in 4 tranches of 25 basis each, effective from September 2025. This move is timely for the Indian real estate industry and can have deep pinching implications across all stakeholders, ranging from the aspiring homeowners to developers and investors. This hectic reduction not only reaffirms the RBI's commitment to supporting economic recovery, but also displays stability and growth, particularly for interest-sensitive industries like real estate. Talking about the company's performance, the retail loan book grew by 18.1% YOY to INR 76,923 crores as on 30th June 25. The total loan book of the company stood at 77,732 crores as on 30th June 25. The affordable and emerging market segment forms 37% of the retail loan book. Our overall collection remained strong in Q1 FY26. We had considerable recovery contributing to reversal in credit cost of minus 27 basis. The gross NPA as on 30th June is 1.06%. We continue to work towards achieving 1% NPA. NIM remained stable at 3.74% during the quarter. Achieved ROA of 2.57% for Q1 on an annualized basis. Let me now talk about in more detail on the performance achieved during the quarter. On disbursement during the quarter, we focused on high-yielding business. Disbursements in affordable segment grew by 30% YOY and emerging market segment by 32% YOY. The disbursements in prime segment have considerably been slowed down to avoid pressure on margins. As a result, the overall retail segment disbursement grew by 14% YOY during the quarter to 4,980 crores. We will continue to focus on a strategy to grow affordable and emerging market segments. Total pan-India branch network of the company is 356 branches. Out of 356, 200 is inaffordable. During the quarter, the company had reclassified 20 branches from western region having a potential of giving high-yielding business. So these were the 20 branches which were in prime segment as per our classification, but these 20 branches had the potential of generating business at a higher yield, and therefore these 20 branches have been moved to emerging. To that extent, all the numbers are post-recast. So with this, the emerging market branch count has increased to 80 branches. All the numbers for past periods have been recasted for like-to-like comparison. With our large pan-India presence, we are ready to capitalize the opportunity available in Tier 2 and Tier 3 cities. We plan to add 40 to 50 branches annually. That is the plan for this year as well. The gross NPA improved to 1.06% as on 30th June 2025, as compared to 1.08% on 31st March 2025 and 1.35% as on 30th June 2024. During the quarter, we recovered 57 crores from retail and corporate put together. The company has a remaining written-off pool of around 700 crores in corporate and 400 crores in retail. On borrowing mix, the reduction in the repo rate resulted in 8 basis decline in our cost of borrowing to 7.76% in quarter 1, from 7.82% in quarter 4 of FY25. On an incremental basis, the cost of borrowing declined by 39 basis during the quarter. Resultingly, we have also reduced our PNB HFR by 10 basis, which is applicable from 1st July 2025. NIM remained stable at 3.74% for the quarter versus 3.75% in Q4 of FY25. For FY26, we expect NIM to be around 3.7%. On profitability, our efforts across parameters aided in improving the profitability. Our return on assets on annualized basis is 2.57% in quarter 1 as compared to 2.55% in FY25. ROE was at 1.39%. With this, I would like to hand over the call back to Deepika.
Thank you, sir. I'll now request Vinay, our CFO, to talk about the financial numbers.
Thank you, Deepika. Very good morning to everyone. As you would have heard from MD sir, and you would have seen from the results, our loan book has grown 16% year-on-year, and retail loan book has grown 18% year-on-year in line with our guidance. Driven by the strong performance of asset book growth, P&L also reflects a similar trend. Let me cover some of the P&L highlights in more detail. So you would have seen yield for the quarter is 9.99 versus 10.03 in Q4. With respect to borrowings, with decline in repo rate, borrowing cost declined by 8 basis to 7.76. The incremental cost of borrowing declined by 39 basis to 7.44% in Q1 as compared to previous quarter. Our net interest income during the quarter was INR 760 crores, increase of 17% year-on-year and 4% quarter-on-quarter. NIM remains stable at 3.74% in Q1 in comparison to 3.75% last quarter. With the decline in cost of borrowing post rate cuts, we have also reduced our PNB HFR by 10 basis effective from 1st of July 2025. Gross margin now stands at 4.06% versus 4.27% in Q4 and versus 4.03% in Q1 FY25. Our operating expenses grew by 12% year-on-year to INR 216 crores versus 193 crores in Q1 FY25. The increase in operating expenses is much lower than the increase in retail loan book of 18%, driving positive operating leverage for the company. Our OPEX to ATA for Q1 is 1.02%. We continue to maintain our OPEX to ATA guidance of around 1 to 1.1% going ahead. Our pre-provision operating profit has grown 17% year-on-year to INR 632 crores on an overall basis. Credit cost continues to be negative at 27 basis for Q1 FY26. During the quarter, we have recovered 57 crores from the return of fees. Happy to report a PAT of 534 crores in Q1, which is up 23% year-on-year. ROA improved to 2.57 in Q1 from 2.55% during last financial year. ROE stands at 12.4% for Q1 FY26. With respect to CRAR, it remains healthy at 29.7%, out of which Tier 1 is 28.96%. Our book value now stands at 673 rupees. With this, I now hand over back to Deepika for taking this forward.
Thank you, Vinay. I'll now request Dilip, our Chief Sales Officer for Prime and Emerging Business, to give segment performance updates.
Thank you, Deepika, and good morning, friends. Welcome to the call. Appreciate you taking the time out. For the quarter gone by, we managed to do well on growth as well as asset quality. Given the scenario of the rate sensitivity in the market after the repo rate drop, we decided that with growth and margins being a priority, we will choose to grow the prime book at a slower pace and focus more on the emerging markets. As you can see, the prime and emerging markets book together reached 71,000 crores, a growth of almost 13% YOY. On disbursements, the disbursements in prime markets grew by 1%, whereas the emerging markets business grew by 32% YOY to 1,736 crores. Another margin accretive business is NHL, where we did 1,315 crores, 50 crores disbursements for the quarter, a growth of 41% YOY. A few highlights. The share of emerging markets business is going up consistently in disbursements, contributing to 35% in Q1 of FY26. This was 30% last year Q1. The business in emerging markets is generated at a yield increment or a premium of 35 basis points over the prime business. NHL also stood at 35% of incremental disbursements in Q1 FY26. This was 29% last year in the same quarter. Even in the prime markets, the NHL mix has gone up to 30% in the first quarter. So like I said, the focus continues to be growth along with margins and will continue to be in the quarters to come as well. Keeping this in mind, we had also set up an exclusive NHL team in 10 markets across the country. This is shaping up well, has already started contributing to disbursements and will hopefully contribute to 100 to 150 crores of incremental disbursements in the quarter to come. To strengthen our NHL offering, we also launched a fixed rate offering, which has also been received well across markets and will help us contribute further. So to summarize, as we navigate this journey in the coming quarters, we will focus on margin accretive business and rely on our strengths across distribution, our strong brand presence, our technology, and make sure that the company manages to prioritize all its imperatives: growth, asset quality, and margins. Thank you so much, and back to you, Deepika.
Thank you. Dilip, I'll now request Valli, our Chief and Sales Collection Officer for Affordable Business, to update on the segment performance.
Thank you, Deepika. Good morning, everyone. It's my distinct pleasure to share with you the progress we have made in our Roshni business over the last quarter. We have concluded first quarter of the financial year with a remarkable loan book of 5,744 crores, reflecting a phenomenal 143% year-on-year growth, up from 2,361 crores of Q1 of the previous year. And we have also doubled the loan book in 1 year from 2,361 crores to 5,744 crores in June 2025. Our disbursements performance tells an equally compelling story. In Q1 FY26, we disbursed 765 crores, delivering 30% growth over 586 crores in Q1 previous year, demonstrating strong momentum and growing market acceptance. And our incremental yields have also improved, touching 12.1% this quarter compared to 11.6% last year, driven by our focus on high-yielding segments and Tier 3 and Tier 4 markets. Over the past year, we have added 40 branches, taking a total footprint to 200 branches across 130 potential districts in 15 states. I'm happy to report these branches have started operational and started to contribute significantly to our business. We have also forayed into 3 promising new markets, namely Punjab, Chandigarh, and Northeast, with plans to deepen our presence in the coming fiscal. Our pan-India operations are well balanced across 3 zones, North Zone contributing 35%, followed by West at 35% again, and South at 30%. The geographical balance ensures resilience and consistency in our growth. Tamil Nadu leads in our AEM, followed by Uttar Pradesh, Maharashtra, and Madhya Pradesh. Our customer profile continues to evolve. Self-employed rose to 41%, up from 38% a year ago. Informal segment sourcing grew 30.4%, up from 26% last year, now forming a sizable part of our book. 74% of the portfolio is within the ticket size of 25 lakhs, and 34% of our portfolio remains non-housing loans. Importantly, our portfolio quality remains strong. Bounce rates are well controlled at 11%. NPAs are impressively as low as just 0.3%. We are incredibly proud of what we have accomplished. With the momentum and strong foundation we have laid, we are confident of closing the financial year with a loan book approaching 9,500 crores. Thank you so very much for the continued support and trust. Over to you, Deepika.
Thank you, Ali. Renju, we can now open for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Renish with ICICI. Please go ahead.
Hi, sir. Congrats on a good set of numbers. So just 2 things. One on this steady state ROA from FY27 onwards. So currently, we are enjoying provision right back, and that is supporting our ROA. But once the credit cost normalize to say, let's say, 20-30 basis points, obviously ROA will get impacted by almost 50 basis points, in a sense, credit cost of 20-30 plus the right back, which we are enjoying around 20 basis points. So what are the levers do you see which can offset the impact of credit cost normalization going ahead?
Okay. So I think as rightly pointed out to you, we would have support from recoveries maybe for next 5 or 6 quarters. And after that, actual credit cost is going to be about 25 basis. While we have few levers, on improving margin, which is today at about 3.74, 3.75%. So we plan to take NIM to about 4 to 4.1. So that will offset. We are increasingly trying to increase the share of origination from affordable and emerging. And now we are trending within the segment to the high-yielding segment. So we will see yield improvement in affordable business, in emerging business. The prime Q1 was little tough because of 2 reasons. One, cyclical, and the second because of repo cut, almost about 100 basis in about 4 to 5 months' time. So this may not be the case going forward. So we will also try and see if we can slightly increase yield in our prime book. And as mentioned earlier, this year we have launched a new vertical called Loan Against Property. So these 4 verticals, yield improvement will help us to improve our margin. And with repo going down, with the lag effect, we will also see some benefits on the cost of borrowing. So that would help us to maintain ROA of 2.5%, beyond 27 as well.
Got it. So just a follow-up on that. So even as of today, on a stock basis, our non-actual portfolio is, touching 30%, to be precise, it is 29 as of June. So to what level you would like to expand this, mix in terms of NHL and HL? Because then obviously under HFC guidelines, there is a limited leeway to the extent we can scale non-HL.
So I think the increase is going to be by 2.5 to 3%, not beyond that. But I think the idea is not that. The idea is that we are focusing on markets where within NHL we can try and get good profile customers at a slightly better speed. So it is no mix of both. One is slightly increasing in the mix. Number two, also trying to increase the mix.
Got it. Got it. And sir, just the last thing on this, asset quality bit on the affordable housing. So obviously, the gross NPA has been rising from last 3 to 4 quarters, and still it is one of the lowest when compared to peers, even 30+ CPD. But sequential increase, in gross NPA quarter by quarter, how does one should read this data point? Obviously, one thing is that the seasoning impact might be kicking in, but is there anything else which is sort of driving this higher gross NPA quarter by quarter, or it is just seasoning?
No, see, actually, if you look at quarter one, it is cyclical, and this is true for all the segments, not just affordable, even prime and emerging, and this is across the industry. So for us, affordable book is behaving very well. If you look at a bounce, which is a starting point, it is still, below the industry average. It's about 11.5%, right?
Yeah.
So, if you compare, with some of the players, obviously the bounce rates are in higher, I think northwards of 18-19%. So I think portfolio is behaving well, very much under control. See, now we started this business in Jan 2023. So now it is almost no more than 2.5 years. So the book is maturing. So obviously we will see some delinquencies in 30+, 60+, 90%, but I think overall we would always be much lower than the industry average. And overall, as an enterprise, as an organization, we want to keep a NPA at 1%. And even in affordable, we would not now. I think in the quarters to come, we would ensure that our NPA is little less than 1%. I think that's the plan. So we don't see any change at all, because even in quarter one, a bounce rate is,
it's 38-11%.
Absolutely, yeah.
Okay. That's it more from my side, sir. Thank you and best of luck.
Thank you.
Thank you. Next question comes from the line of Suraj Das with Sundaram Mutual Funds. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Sir, one question I think you alluded on the margin part, but the question is, despite favorable movements towards higher yielding portfolio, it is not getting reflected in the yield part. Your yield has not seen, let us say, much of benefit over the past 4 to 6 quarters, despite your favorable loan mix movements towards emerging and affordable, which are relatively higher yielding versus prime. And prime as a share is right now, I think 60, 63, 64%. So the question is, sir, what would be the inflection point when it will get reflected in the yield part? And the related question to that is, sir, in terms of assignment income, where do you recognize this in the P&L? Is it in the interest income or is it in the non-interest income? I think that is my question one.
So, see, the way we look at it is that, we are very clear on our margins, right? With the repo going down, so obviously these also would get moderated to a certain extent. So we are very clear on the margins, what we need from each of these segments. So because with repo going down, even a cost will go down. Maybe with a little bit of a lag, right? And therefore, we don't have too much of control on the cost of borrowing or on the yield, but we have full control on the margin, right? So it was almost about 100 bits in last 6 months' time. To that extent, if you look at the yield, it is still very stable compared to quarter 4 and quarter 1. Yield is still very stable. So I think the way to look at it is, we should look at how is the margin blending. So last quarter it was 3.75, this quarter it is 3.74, and we are guiding that this year yield will be around 3.7%. So earlier I had guided between 3.6 to 3.65. So now we are upping the NIM guidance to around 3.7%. So we are very, very clear on the margin. Yeah, there could be slight variation in the yield, slight variation in the cost. I think that is the way how we look at it.
Yeah, and on the securitization income, it is part of interest income.
Sure, sir. And sir, you have not taken any PLR rate cut, right? Whatever Bajaj or Can Fin does. So, what is your plan on passing on the interest rate thoughts on the planning segment side? Do you intend to take any PLR rates cut in the coming quarters, or let us say in the second half?
So two things happen when there is a repo cut. So one is the origination yields will go down. This is for all, including PNB housing. Second is, the benefit what the company accrues because of the repo rate cut. So we have got the benefit of 8 bits, and we will be passing on 10 bits from 1st of July.
Okay, sure. And so last question, I think extending the registration, that in terms of this asset quality fees in the affordable housing, while the numbers are still muted, but let us say whatever customer segment that you are serving, according to you, what would be the, let us say, steady state number where this 30 DPD or 90 DPD or even bouncer is stabilized? What is that level?
So we are, as I mentioned earlier as well, within affordable, there are 3 sub-segments: high risk, medium risk, low risk. And our mix is going to be 20, 60, and 20%. So 20% of origination will be from high risk segment, 60% from medium risk segment, and 20% from low risk segment. So given this mix, we feel the peak of NPA for us is going to be somewhere around 1 to 1.1%.
Sure, sir. Got it. All the best, sir. Thank you, sir. That is all from my side.
Thank you.
Thank you. Next question comes from the line of Abhishek Kumar Jain with AlphaStreet. Please go ahead.
Thanks for the opportunity and congrats for a strong set of numbers, sir. Sir, my first question on the prime segment, in this quarter we have seen very muted growth of just 1%. So what is your target for the disbursement growth in the prime segment for FY26?
So, quarter one, as I mentioned to you, was a little unusual this time because quarter one being cyclical also got added with the rate cut, right? We are, as I mentioned to you, we are very, very clear on margins. And we are doing 2 things. One, we are increasing, if you look at our disbursement share in quarter one, emerging and affordable is 50%. So 50% origination is from affordable and emerging. So we are trending more towards origination from affordable and emerging. So the growth in prime is going to be a balanced number. So we have guided book growth of 18% for this year, and that will definitely be met. So if you look at the book growth in prime, it's going to be in single digits this year, and this is as per plan. And this is a strategy not to grow the prime book faster. It will always be a balancing number. So the growth in book in prime is going to be around 8-9%, and the disbursement should be around 12-13% for the whole year.
Okay. And my second question on the ROE side, the ROE is moving between 12 to 12.5, and just wanted to understand what is your roadmap for achieving mid-teen ROE in the medium term?
See, I think we all should understand that we raised capital recently, and because of that there is a drag. Otherwise, all of the parameters are in line as per the projections and as guided. So we are also trying to look for opportunity where we can try and increase the pace of growth on book in all the segments. So I think in about, let's say, 3 years or so, we should get to around 14%.
Okay. Thank you. That's all from my side.
Thank you.
Thank you. Next question comes from the line of Abhijit Tibrewal with Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, thank you. Am I audible?
Yes, you're audible.
Yeah, sir. Hi, good morning. Sir, just 2 things. Congratulations on first quarter results, and also heartening to see that you've increased your NIM guidance for the full year to 3.7% now. But just trying to understand, given that we've seen a 50 basis points rate cut last month, repo rate cut last month, what could NIM trajectory look like for the next 2 to 3 quarters now? Why I ask this is, I mean, versus 3.74 that we reported in the first quarter, if we are guiding for full year of 3.7, that essentially means that we're not looking at any margin compression in the coming quarters. So is that the right way of looking at it? Just trying to understand what could mean trajectory look like in the second and third quarter. That's my first question.
So definitely, if you look at next 2 to 3 quarters, there could be further cuts. I would not guess as to how much it's going to be. There could be cuts, right? But at the same time, we also have a very clear plan to increase our margins in all the segments. And therefore, we are very confident our limit is going to be around 3.7, give or take plus or minus to this here and there.
Got it, sir. And so then the second thing I wanted to understand is, I mean, you have yourself kind of passed on 10 basis points effective July. Most of the other, I would say, HFCs, right, have passed on in that same ballpark. Someone is at 10 like you, some others are at 20, someone else at 25 basis points, PLR cuts that we have seen. So there are two parts to that question that I wanted to understand. First thing is, I mean, what's our kind of strategy around these ALCO meetings and PLR cuts? What I'm trying to understand, is it the quarterly recalibration in PLR that we do, or can it be done even during the middle of the quarter? And secondly, despite these large HFCs not passing any PLR cuts, despite that, we are not seeing any significant increase in BT outs. So where is the disconnect? I mean, compared to past cycles, there used to be a big pressure on balance transfers in a declining rate cycle, and which essentially meant that large HFCs had to pass on, I would say, rate cuts even before their liabilities got repriced. So if you could just help us understand this better.
We manage the cost very efficiently, cost of borrowing very efficiently, and whatever benefits we get, we pass on to the customer. Now, it will come with 3 to 4 months lag, and we will also follow the same time schedule. So that is the reason you will see different companies passing on different, maybe some 5 days, some nothing at all, some 10, some 15, right? I think we need to look at what works for PNB housing and PNB housing customers, number one. Number two, we have a very strong retention fee. We always believe that retaining a customer is more profitable than acquiring a new customer. And therefore, we have a very good handle on our total closures. If you look at total closures for quarter one, it is 16%. So if you remember, it used to be about 21, 22%, I think, little over maybe 7, 8 quarters back, and we have brought it down to 17 and now further down to 16. So if you look at our BT out, it is at 6%. And if you look at the BT in, we have on prime in quarter one, BT in was slightly lesser than BT out. Otherwise, BT in and BT out both are still in prime. This quarter being a little bit of exception. So for this quarter, on prime business, BT in is slightly lower than BT out. On emerging business, BT in and BT out is almost similar. And on affordable, we have significantly higher BT in compared to BT out. So we have a very good handle on customer retention, and eventually BT out is going to be a much controlled number for us. And that is why we are able to do.
Got it. And so just one last data keeping question. You shared it in the news call. So in our affordable business, this quarter, whatever disbursements that we did, what was the proportion of BT ins in the affordable business?
So BT, this is on the portfolio. So BT in was about 1%, and BT out is hardly anything because it's a new book.
And so BT in, you said, was 1%.
BT out.
BT in?
12%.
Okay. Thanks, Deepika. Yeah, that's all from my side, and congratulations and all the very best.
Thank you. Next question comes from the line of Viral Shah with IIFL Capital. Please go ahead.
Yeah, hi. Good morning, and I would say congratulations on good set of numbers. So two questions. One is you have reclassified 20 of your prime branches to emerging segment. I know historically that is how we started, say, building out this segment. But what this also means is that our share of, say, affordable plus emerging, which was 25% until last quarter, goes up by close to 11%, right? So does our, say, target mix for FY27 or by end of FY27 of 40% also correspondingly rise to 50%? Because with this 10% kind of shift, inherently the profitability of the business currently doesn't change, right?
So there are two things.
At an overall level, I mean to say.
There are two answers to this question. So this movement of branches, from prime to emerging or emerging to affordable, is more market driven and segment driven. So we are doing this for last now 3 years. Right. So when we started emerging business, so we carved out certain set of branches in the prime, which we see that these branches cater more to emerging segment, and therefore it was almost about 23 and 27. So this is a continuous exercise, because our strategy, our focus is to completely move towards affordable and emerging in the next 4 to 5 years time. This will be an ongoing process. This will be a continuous process. To answer your second question, yes, the 40% will now obviously go up, definitely. Because when we had planned 40%, we have not taken into account the movement of these 20 branches. So definitely the 40 will go up.
Okay, so that 40 goes to 50% now. Is that right?
I am not. Yeah. So we need to work out the math. Maybe give or take 1 or 2%, but definitely 40 will go up.
Got it, sir. So my second question was on the
going forward, depending on the opportunity, we would convert prime into emerging. The way we would convert is that wherever we feel the branches are more closer to emerging markets, we move that from prime to emerging, and we will recast so that we have an apple-to-apple comparison. Or we might take a decision to close a prime branch in the location and open one emerging branches in the same city if the segment is different. So this keeps on happening.
Got it. That's very clear. Sir, my second question is on the asset quality piece. Now I understand, of course, our book is now gradually getting seasoned on the affordable side, which is why on a sequential basis we see these numbers. Can you give some sense on what is the rollback rate? Because as you mentioned, see, bounce rate I think is controlled and is materially lower than the peers. Of course, on a seasoned book for them. But when I look at, say, 1.5 year, say, on a lagged basis at 30 plus numbers, I think we are still probably somewhere in line with what peers are there on the seasoned book. But on a sequential basis, that number has increased. So while the bounce rates are controlled, what is the kind of, say, rollback rates that we see after, say, maybe missing on a, say, 1 plus DPD or 30 plus DPD, if you can give those numbers?
See, I had partly addressed this question earlier. So I had also told maybe next 4 to 5 quarters we would see an NPA in affordable books, let's say close to maybe 0.75, 0.8%, and eventually it will peak at about 1.1. So given the mix of the segments into which we are within the affordable segment, we are looking at a peak of about 1.1%. And if you look at our bounce, it is still at 11.5%, very much under control, because at least the bounce the book is vintage, right? Even to take on a lag basis, I think that if you look at the cases which are into various buckets, it's very encouraging. Yes, 30 plus has gone up, 60 plus also will go up, 90 plus also will go up, but that will be much lower than the industry average. In terms of roll forward and roll back, we will share the numbers separately with you because we don't have the numbers separately.
Sure, sir. Thank you. And just one clarification, sir. When you said that you will be better than the peers, you mean to say on a seasoned book, right? Say maybe a year or 2 years down the line.
Yeah, yeah. So I'm only saying like-to-like comparison. On a like-to-like comparison, we would be definitely better than the competition. We'll be better than the industry.
Got it, sir. Thank you so much, and all the best.
Thank you.
Thank you. Next question comes from the line of Vatsal Nagaria, an individual investor. Please go ahead.
Good morning. I have a question on the affordable housing segment. One of your peers mentioned that they are seeing developers pulling back supply in the segment as a result of difference in the new PNB scheme. So are you seeing going forward that the system level growth in the affordable housing will slow down? And how has been the on-ground implementation of the PNB 2.0?
I didn't hear the first part of the question. I heard the second part. If you could please repeat the first part.
Yes. So it's one of your peers mentioned that developers are pulling back supply in the affordable housing segment as a result of the difference in the new PNB scheme. So are you also seeing that?
No. Okay, I'll tell you. So it is not the right comparison. So inter-subsidy scheme with the earlier PLSS scheme. For many reasons, due to paucity of time, I just mentioned 3 reasons. Now, in terms of quantum, so this time the inter-subsidy amount might be little less. But I think for the lending institution and for the customer, it is a big win for 3 reasons. One, the subsidy what the customer gets is in 5 annual installments. So within those 5 years, customer won't be allowed to switch. If customer switches the institution, then the subsidy stops. So this is a big plus for the lending institution because customer would remain on book for at least 5 years, number one. Number two, customer cannot be delinquent. If customer becomes delinquent, then the subsidy stops, which means customers are motivated to keep their repayment track record satisfactory. So these are the benefits. And number three, this time, as a lending institution, we also get affordable funding, from the regulator, NHB, so that we can on-lend to our customers. So these are also benefits. So it can't be exactly compared with the earlier scheme. This scheme has taken off well, and we are seeing good traction. And this will gain more traction in the coming quarters. So we see this scheme as very, very attractive, and this is going to propel growth in the affordable segment.
Okay, thank you.
Thank you. Next question comes from the line of Wuzmal Handu with Goldman Sachs. Please go ahead.
Hi, good morning. Good morning, team. My question is on emerging markets.
Your voice is very feeble. It can be a little bit louder, please.
Are you able to hear me better?
Yeah, slightly better.
Yes. So my question is on emerging markets. The book has grown quite nicely, and therefore wanted to ask a question on asset quality here. How are the early indicators stacking up for this part of the book? If you have some numbers that you could also share, or any color as well on bounce rate or 30 DPD, etc., that would be very helpful.
In terms of segment, prime and emerging, there is very less difference. And surprisingly, for us, emerging markets, the delinquencies are a notch better than prime. So that may be because of legacy book, but even on the new origination, we are seeing no difference between prime and emerging. So in terms of credit costs, I had mentioned earlier on the prime, we expect a credit cost of about 18-19 basis. On emerging about 20 to 22. So that's the difference between prime and emerging, not too much of difference.
Okay. That helps. Thank you so much.
Thank you.
Thank you. Next question comes from the line of Yash with MIPL. Please go ahead.
Hi, am I audible?
Yes, you're audible.
Most of my questions are answered, but minor clarification. I just wanted to understand what are the KPIs that are being tracked internally that allow you to switch a prime branch into an emerging markets branch? Like, what are the things that they have to achieve internally for this reclassification to happen?
there is nothing. It is market driven. So if you feel that in a particular market offers opportunity, to originate at a higher yield, see, we need to understand. So every market would have multiple segments. Certain segments would be dominating. So we identify locations, where the potential for emerging is slightly higher than prime. But we have a prime branch. In those cases, we migrate the branches from prime to emerging. So this transition will take about 3 months' time. And after 3 months' time, we let go of prime business and we completely focus on emerging business. So that is the approach what we take. It is more market driven and more yield driven.
Okay, got it. Congratulations on a good set of numbers. Thanks.
Thank you.
Thank you. The next question comes from the line of Omkar Shinde with Ascendancy Capital. Please go ahead.
Hello, am I audible?
Yes, you're audible.
Yeah, thank you. So a few statistical questions, then I'll come to my questions. So what is the overall LTV of the book and what is the LTV in the affordable segment?
Overall LTV should be around 66-67%, and in affordable it comes down to about 53-54.
Sorry, the affordable one?
53-54.
53-54. Okay. Sir, I have a statistical question on what is that individual housing loan book on an overall basis, the individual housing loan.
70%.
71% on book.
71% is our individual housing loan book. Okay.
On book or the AUM?
On loan book.
On the loan book. Okay. Got it. And finally, what is the number for the sanctions for this quarter? Number of sanctions that we on amount and count?
We generally don't share that because what happens is that for a sanction, really, beyond that point, it doesn't really matter because there will be a lot of cases which we might lose to competition, and we might. So if you look at on a average, let's say last year 4 quarters, we would be sanction to disbursement ratio should be somewhere around 64-65%.
Okay. So actually, because earlier we did that trend,
why we don't share this number is that we can't assume that 35% is there for me in the next quarter. Because in the 30% we might end up losing maybe 3, 4, 5%, and then we might also gain similarly.
Understood. So sir, now going to the yields on the questions part. So the yields we have seen to buy contract in the affordable segment 6 to 12.1. Given that we have already started taking a few cuts in the rates, where do you see the yields in the affordable segment, stabilizing it? Because as you're saying that margins are going to be a focus area, and if I'm right, you said that we will be trying to reach over the medium term 4% of NIMs. So what is the outlook there?
So let's say this year the yield should be about 12.6 to 12.65, and next year getting close to 13.
Okay, close to 13 next year.
Yeah.
Understood. And with respect to asset quality, is there any specific region, like for example in Karnataka or anything where the ordinance is there, or any specific region outside where we are seeing any asset quality issues? Because one of our peers is saying that in Telangana they are facing a lot of issues. Karnataka issues are being solved. So some color on the southern region or any place else where we are seeing any early warning signs with respect to asset quality. Because although asset quality has remained good, bounce rates are in control. Are you is it like calm before the storm situation?
No, we have very less overlap between our affordable customers and MFI customers, and therefore we don't see any stress anywhere.
So not MFI, so this is like your affordable housing or housing HFC peers. So like one of the peers who, so is there any asset quality issues that you're seeing, early warning signs, anything of that sort of thing?
Not at all. So why I mentioned MFI is that if you see in last 4 to 6 quarters, there was stress in MFI and also in the small ticket unsecured segment. So if you have to talk about only affordable, we don't see any stress.
Okay. And finally, on the credit rating, so we are at a double A plus. We have seen a few of our peers getting credit rating improvement. What is our status on that? Can we expect credit rating hike to?
We are also hoping an upgrade maybe next few quarters.
Okay, so any connections or talks with the credit rating agency?
Discussions are on, so we are hoping in the next few quarters we should also get upgraded. So
maybe by end of FY2026 we could see credit rating hike. Would that be possible?
I can say next maybe 4 to 5 quarters time.
Okay. Thank you. I'll join back with you.
Thank you.
Thank you. Next question comes from the line of Pawan Kumar with Shade Capital. Please go ahead.
Thank you for the opportunity. I'm audible?
Yes, you're audible.
Yeah. So my first question is regarding the yield differential between prime and emerging is roughly 20 to 30 basis points. Would that increase going forward?
It will increase.
Okay. And secondly, like as you're saying now, your more focus is towards emerging market. Are we getting to softening of supply side in terms of like kind of like those we are looking for in the prime, or is it just like we are recalibrating towards emerging and affordable?
No, there is lot of demand in all the segments, whether it is super prime, emerging or affordable. We want to do best on prime because prime comes at a very thin margin, and therefore we want to do best of prime and more of emerging and affordable. That's the only reason. It's only for profitability.
Okay. Thank you for the clarification, and congratulations again for good set of numbers. These are my questions. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript of this call will be uploaded on our website. Thank you.
Thank you. On behalf of PNB Housing Finance Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.